This is the current federal tax developments for the week of August the 3rd, 2026. Current federal tax developments are brought to you by your state society of CPAs. I'm Ed Zollars this week, and this week we're going to cover four major developments. First, going to look at the IRS's second policy reversal on the same matter in Private Letter Ruling 2026-30-002. Second, we're going to get yet another ruling on the Employee Retention Credit Suspension of Business pleading standards. And as you might guess, we are now finding that we're getting consistent runs from the Court of Federal Claims on this ruling and opposite but consistent runs and rulings from the U.S. District Courts in southern Mississippi on this. So it's becoming interesting watching these two go. So we'll talk a bit about that. This is involved here. Third, we've got a tax court reported decision in HRM Holdings Company, which disallowed basically subgroup pooling rules for S corporation histories regarding net operating losses. And finally, we have a civil fraud penalty case in Prezioso, I guess, versus Commissioner, involving corporate paid personal expenses and a dual chart bookkeeping system. In essence, two sets of books per the court. Turns out courts aren't impressed with two sets of books. The one you use for the tax return, the one you give your accountant to do the tax return, and then the one you say that shows your real income. That could be a problem. At least that's what, it's really bad if you then use the quote real income number on a credit application, because the court did not react well to that case. Let's put that mildly, that situation. So let's start out though with this private letter ruling that essentially revokes a private letter ruling that revoked a previous private letter ruling. So we're back to the first one. Let's talk a little bit about what this is. This involves a specific type of annuity product that the IRS had been asked to rule upon. And what happens in this case is that the IRS does essentially a regulatory about face on this particular issue, right? Looking in this case at some issues of trying to, let's say, work or create a different variable annuity concept that was there. Now, the IRS essentially had issued private letter ruling 2014-24014. This is what starts that whole system of structures. 10 years later, in private letter ruling 2024-26001, they indicated, we're not sure we agree with that anymore. And now, in private letter ruling 2026-30-002, it's effectively released on July 24th. Just kidding, right? Okay, yeah, you can go back and use that 2014 ruling. So what happened in this case is this retroactive revocation of private letter ruling 2024-26001, a ruling from basically 2 years ago, reinstates that prior 2014 ruling. Now, restoring that original ruling under 2014-2024-014 essentially protects variable annuity contract designs and policyholders. Now, the policyholders that had done this transaction before the IRS says, hey, you know what? We don't think we agree with this anymore. They were protected. We'll discover that under this. So they didn't have a problem, but you couldn't write new ones. Obviously, if you're the carrier that was marketing this product, that's a big problem. And we need some explanation. Now, this, in essence, highlights some of the complex administrative procedures and stability of IRS private letter rulings. They are able to be revoked, especially when you use them for a purpose like this. Now, and also talks about, at least in the current IRS view of this matter, the durability of tax-deferred status under Section 72 for annuity contracts. We're going to take a look at that a little bit here, right? Now, this underlying transaction involved a stock life insurance company that was proposing what we'll call the new annuity option that had non-qualified deferred variable annuity contracts in there, right? So again, the taxpayer was a stock life insurance company organized under state law that qualified as a life insurance company under IRC Section 816A, right? It proposed to offer a new certain annuity option with variable payments under its non-qualified deferred annuity contracts, right? The contracts here are registered with the SEC under the Securities Act of 1933, right? And constitute variable contracts under Section 817D, right? And owners are permitted to allocate net premiums and earnings to various variable investment options. The idea here seems the design basically was we're going to get an annuity here, but this annuity is going to have a variable payout per year based upon, exactly, what contracts you put in. And we're going to let you kind of roll your old annuity, convert it into this. So your standard annuity could have this option to turn on. So, we're basically there. Okay. Now, there were three to select this new annuity option as a payout option of the contracts. The contract owner must clear three strict gating requirements, right? First, there is a strict minimum account value that's applied to a new annuity option upon election. You've got to have a certain amount involved. Second, the account value must exceed the investment in the contract. There must be untaxed, unrealized gain, basically untaxed gains, right? So essentially deferred gains inherent inside the contract when you elect this option. And finally, you've got to meet strict age limits, right? Now, so in essence, that's required on this election receipt date. Now, contingent owners or joint annuitants can be added to accommodate single or non-natural owners for this particular structure as we get into the payout. So there were ways to do this here, and the IRS in 2014 approved this, right? Now, once you select this option, we're going to follow how it does. The owner selects a fixed term for this annuity. The term is bounded by the year the owner reaches a specified age range. So you have a fixed term now for the annuity. You've locked it in. That duration's fixed, cannot be changed. The account value fluctuates with investment performance, but over the selection term, the account value will systematically decrease as we pay out of this account. Bottom line, that's why every year's performance is going to impact the payout on the account. Right? In the final year, the value reduces to zero and the contract terminates. If positive performance leaves a surplus in that final year, the final payment is increased. We're going to zero this turkey out no matter what. So bottom line, this is how this thing works. So it's going to be not an annuity in traditional sense where, you get paid X dollars for this term or for life. It's going to be one that you're going to be paid a variable amount based upon the value left in this annuity. And this is one of your choices, one of your options on the contract was to select this sort of payout. This is what they were trying to offer. So essentially, you could decide at the time you get it, you know what, I want to take the market risk. I'm going to go ahead and select this option. So that's a possibility. Now, there's a designated yearly formula divides the account value to determine what our payments are, right? So it's to calculate on a designated calculation date. For the first year, this is the election receipt date, is the date on which we do this. For subsequent years, it's the day preceding the anniversary of the election receipt date. Formula is simple: current account value divided by the remaining years in the term. So this ensures the divisor decreases by exactly 1 year each year, forcing a full amortization over the term while allowing payments to fluctuate with investment performance. And you can receive your payments in annual, monthly, or quarterly installments. So essentially, it's going to work to zero over time. Now, the contract owner does possess post-commitment commutation rights to stop the payments and take my money, but exercise them is going to trigger an immediate and rather stringent, nasty tax consequence, right? So after the starting date, yep, you can redeem some or all the account value at any time, but the tax consequences are severe. A partial commutation is treated as fully includable in income, which serves as a huge disincentive to go draw funds out of there, right? A complete commutation, which terminates the contract entirely, is taxable to the extent it exceeds the remaining cost basis under Section 72E. So, this distinction is crucial when we get to the IRS's eventual constructive receipt analysis. Now, What happened in 2026 then? I mean, 2014, we're told this is okay, right? It's okay, great, we're fine. So in 2014, the IRS says there was not constructive receipt of the investment effectively, and then reinvested into this new program, which is effectively where the problem could be, right? Is this a significant change that's causing us this sort of problem? That's effectively, you had the right to all the cash, and you instead moved it to this new vehicle, or what's viewed as potentially a new vehicle, right? Now, in 2024, the IRS reversed course in private letter ruling 2024-26001, claiming tax deferral in this case was inconsistent with its current views. Okay, kind of interesting here, so not consistent with our current views. Okay, so although Section 7805B relief was granted to make the retroactive prospective, obviously all new sales of contracts with this option were terminated. So you already had a contract with this option, you were fine. But if you didn't, now we're sitting here because IRS is saying tax deferral. So it revoked, and we're sitting in no man's land in this case, right? Finally, in 2026, the IRS then reconsidered, retroactively revoked the 2024 revocation, and restored the 2014 holding as if 2024 bit had never occurred. Now, this is interesting because sometimes we see this disruption due to changes in administration and different views of the service, which happens. But I will remind you that 2014, Barack Obama was president, right? And had been there for a while. So the IRS was, essentially, it was basically all the appointments had been made. He was, they were in charge. So there in 2024, in 2014, they found it fine. Late in the Biden administration, the IRS changes its mind, right? And now, 2 years into the Trump administration, we end up getting this. I don't think this is wholly, or probably even at all, related to changes of administration policy. It may influence it slightly, but it seems like that, if this was something that was really important to the incoming administration, this would have been revoked very quickly. And conversely, if it's something that we would expect Republican policy to favor and Democratic policy not to, well, how'd the first ruling come about? It's kind of that background. So it's kind of an interesting issue. But the catch here is there is always a risk that the service, because of later developments, what they see coming out of the market, what they see as potentially some people have taken this ruling and now the IRS believe have abused it, they might undo it, right? It's only a short-term level of relief. But ultimately, the IRS went back to constructive receipt does not apply. Now, there are essentially 5 reasons offered, and we're back to these reasons. First, Section 772 literally requires receipt of cash before taxation, right? There's no mention of constructive receipt. That's important to understand there, right? Second, the 1982 Deferral legislative history shows Congress wanted to preserve deferral on undistributed earnings. That was kind of the bad thing. So it did not expand constructive receipts to undistributed earnings, even when it established the LIFO taxations for withdrawals under 72E. Now, third, the anti-abuse rules on loans under Section 72, subsection E4A, would cause double taxation if growth were already constructively received. So it seems like that's also a problem. Fourth, Section 264A3 interest disallowance would be redundant. And fifth, Section 72, subsection U, explicitly forces annual recognition only for corporate, non-natural holders, leaving individual deferral essentially intact. So based on these 5 requirements, these 5 issues, the IRS says we're back to we don't think constructive receipt applies in this case. So anyway, if you're selling those things, hey, then we can go forward. If you're not, well, then it probably doesn't matter. Your client's not looking to buy one, then we're good. But as I said, through all of this, if your client bought under the initial ruling, or if they now buy today from that company under this ruling, please remember PLRs technically only apply to the party they're issued to. So you got that little problem too, right? You got to be aware of that. But basically, it's now safe again. We'll see how things go. My guess is the service is not really going to want to revisit this one more time unless Congress revisits it. Okay. So let's go ahead and go to the employee retention credit. This is a case of essentially the case of I Health and life insurances. Maybe that's One Health. I don't know if that's Roman numeral 1 or the letter I, but it's called I Health and Life Insurance Services versus United States. Again, decided on July 23rd, 2026 in the Court of Federal Claims. And in this case, Judge Armando Bonilla issued the opinion, and he established, or basically, in essence, continued the Court of Claims requirements of a relatively rigorous pleading standard for ERC claims under IRC Section 3134 and the predecessors non-codified versions of the ERC that were back, that came back from the very initial, passage of this law when we had the whole pandemic come into play. Now, specifically, the court held that to survive a motion for judgment on the pleadings under RCFC 12C, a taxpayer must allege the government orders caused a discrete, more than nominal portion of his active business temporarily cease. Now, interesting aside here, remember, we have been talking about cases from the Southern District of Mississippi, Southern Northern District. I think they've actually been from both, where they simply said you don't have to specify at this point. So yeah, we are getting inconsistent rulings, but that's the sort of thing we expect at trial courts and different areas. The Court of Federal Claims starts going down this path. In the Mississippi U.S. District Courts, they started going down another path. We're probably going to have, tons of different standards established here until these cases start consolidating in federal circuit courts of appeal. And as I've said all along, this whole process is starting way too late for you to really learn much of anything, if you're in the process, except if you maybe should bail or keep going forward. And right now, the answer is who knows, as a practical matter, if you need this level. Now, again, and I'll also be honest, this is only surviving the motion to dismiss. Even in the Mississippi cases, no court has yet ruled that you can go. In fact, the court, very specifically in the last case we discussed from there, made it clear that you better have something better for me when we actually get to trial. You got to prove something, right? That's going to be the key, right? So although iHealth failed to plead properly, the court deferred its ruling and granted leave to amend. In essence, you can step up now, give me the more rigorous pleading of what exactly you're alleging causes the problem, and we'll let you back in. So they didn't throw them out entirely. The court recognized that this is a bit of a mess right now. It wasn't obvious what the standard should be. And so the court's going to let it go. But in the Court of Federal Claims, it's going to be very clear that you're going to need a much more specific pleading under current rules or under current structures. Now, let's talk about the facts of this case. iHealth, a California-based insurance sales agency with physical call centers located in Fresno and San Diego. Prior to the pandemic, its representatives worked in close-quartered, open-air cubicles. We packed them in, right? Basically, fundamentally. As an essential business within the healthcare sector, it continued operating during the pandemic, but was subject to strict county health mandates. It complied by restructuring its physical call centers, implementing workplace spacing, screening employees, and transitioning some staff to remote work with complex and expensive equipment. So these are all part of the case, right? Facts of the case as put out, in their complaint when they filed asking for the refund. Now, iHealth filed 5 Form 941Xs for amended 941s, seeking the employee retention credit. The claim spanned from quarter 2 of 2020 through quarter 2 of 2021. The IRS paid out the overpayment notices for several quarters, including a net tax refund of $392,010.40 for quarter 2 of 2021. After receiving this, iHealth amended its complaint to drop quarter 2 of 2021. Okay, this is what's kind of funny. They had filed in court, that then the IRS issued the refund, which technically they shouldn't have done. Now, remember, we had an earlier case where the IRS had issued a notice saying, oh, yeah, we approve your refund. Technically, decisions are now supposed to come out of the Department of Justice, not the IRS. Okay, but in this case, they didn't just tell somebody. And remember, in that case, the court said you can't force the check to be issued because the IRS had no right to say that. But in this case, the check got out, right? In response to that, the government filed a counterclaim to claw back that $392,010.40 while filing a motion for judgment on the pleadings to deny the remaining $50,000 claim for quarter 3 of 2020. So there we have it. We're kind of back in that structure. Now, let's go back over the requirements for the ERC under the suspension prong. A taxpayer had to satisfy 3 cumulative requirements, meaning you got to meet every one of these. You fail one of these, you do not get the money. First, the business had to be fully or partially suspended. In this case, clearly it was not fully. So we're looking at partially suspended. Second, there was an order from an appropriate government authority limiting commerce, travel, or group meetings due to COVID-19. Right? That'll be it. And there are some specific rulings they mention here. And third, the suspension was caused by or due to the qualifying order. Failing to establish even one of the 3 prongs makes the taxpayer entirely ineligible for the credit. So in this motion to dismiss, the court is going to, basically say, hey, we're going to look at all 3 of these elements and see whether your pleadings standing on their own are sufficient. We're not making a decision whether you qualify yet. We're just making a decision if, based upon your pleadings, and you can show everything you claim you can show, that would be adequate, right? Then, in essence, that the court, because he's going to be the trier of fact, presumably in this case as well, I would basically say, looking at the facts in the law, the facts, you've proven this, so I've got to that. If you proved all that as a matter of law, you'd get your refund. That's what we're looking at here primarily. Okay, in the first step of the analysis, the court scrutinized which directives from quarter 3 of 2020 were actual orders. A qualifying order must carry enforcement authority or compel conduct through the threat of binding repercussions. Executive orders number N2520, N3320, and N6020 qualified because state law explicitly says they have the force of law. County health officer directives also qualified because they cited health codes and stated in their face that violations were subject to fines or imprisonment. However, the governor's press conferences and press releases did not meet the standard because they were merely informational. So, you've got to show that there was enforcement behind it, not just this to be a good idea, right? If all the governor says is this would be a good idea, then there's not really anything they can do. If the governor says you have to do this, then it becomes, then we can say it's a potentially enforceable order. They said, so while we're accepting these of what you talked about and proving that those caused a partial or complete shutdown, and we know complete's not on the table, partial suspension is what we're looking for, then, this would be adequate, right? Because you did identify orders. If these orders did in fact cause you to partially suspend operations, then yes, you'd be good because these orders would qualify. Okay, the ones we talked about. For the second prong, causation, the court agreed that iHealth met its pleading burden. The local county directives use mandatory shall language, leaving no room for discretion. Government tried to argue that iHealth would have excluded sick workers anyway, but Judge Bonilla rejected this, noting that while the government's primary concern was public health, the business's primary focus was survival. These competing predictions represent factual disputes that are proper subjects for discovery and trial, meaning the government was not entitled, as a matter of law, to assume that, in essence, the company would have done this anyway. Right? that they would have not had the sick workers there absent this. They're saying, look, you might not think it's a great idea to have the sick workers there, but if there was no order requiring it, would sick workers be there? Yeah, they'd be there. Let's be honest. I mean, real world, we know odds are that they would have sick workers there, or workers would just show up, right? Not want because they don't have leave time, whatever. They're going to be there. So we're going to have that problem. On the final prong, whether the business was actually suspended, this is where the court says we have a problem with your pleading. The court engaged in independent statutory construction under the Supreme Court's Loper-Bright doctrine. You're saying, wait, I thought Loper-Bright did not say whatever you're arguing is good. In fact, if anything, it says the court's going to determine the one overall best standard, and the fact you're arguing it means about as much as the IRS is arguing theirs. In fact, technically under Loper-Bright, somewhat less, because we can respect the agency's expertise, right? So there is a little bit of a lean toward the agency, even under Loper-Bright, if you read the case, right? So the court looked, the dictionary definition included that partial suspension means the temporary cessation of a part of the employer's business. Importantly, it integrated the nominal effect standards from IRS Notice 2021-20. It accepted that was that seems like, given the way the law was written, a concept that made sense under what Congress was aiming for, right? To survive a motion of judgment on the pleadings, the taxpayer must plead a discrete, more than nominal portion of its business ceased. Right? That's the key issues. Applying the standard, the court found iHealth complaint deficient. While the occupancy caps and health-related exclusions forced a reduction in on-site capacity, the call centers continued operating all through Q3 of 2020. The business did not shut down any distinct segment of its services lines. Instead, it continued its core function of telephone sales and service through the on-site remote representatives. A capacity reduction or operator modification that is not a partial suspension under the law, saying that that's not by itself that. The taxpayer must allege that they cease performing a discrete, identifiable portion of the business. That is a relatively high standard. See why I wanted people to take these facts to court earlier? I know why they didn't. I understand totally. But we did, and people waste a lot of time getting excited about those cases that were simply the ERC consultants trying to get a home run, which from day one, I never believed those cases were going to do anything. At most, they could say, okay, yeah, that notice, yeah, it's, they said what I knew they'd say. That notice was simply, the IRS's opinion. They're allowed to have an opinion. They're also an enforcement agency. Like a police officer has an opinion about whether or not you were speeding. Okay. Now, the ultimate decision whether you were, if you decide to take it to court, is going to be made in court. But, the police officer doesn't get to make the decision ultimately that's going to say, hey, you've got to pay the fine. But the enforcement agency does get the first call. Okay. Same difference here. The IRS gets this call. And so now the court is saying you must show that you ceased a discrete, non-minimal portion of your business that we can identify. Okay. So, high level, if you're going in court of claims, suggests that for now, district court is probably where I'm going to think the attorneys are going to be concentrating for any new cases they file. Because court of claims looks like it's going to be a really tough road to hoe. Just going to say. Next up is a tax court case, HBM Holdings versus Commissioner, 167 TC number 6. The case was published on July the 27th of 2026. Right. This is a reported tax court decision, which is important, meaning it's deciding a new part of law. This case provides critical guidance on Section 381 corporate liquidations, the so-called lonely parent exception, and the separate return limitation, your SRLY, subgroup rules. The tax court held that those rules barred HBM utilizing a liquidated subsidiary's pre-liquidation net operating losses to offset the consolidated income of the rest of the group. This resulted in full disallowance of millions in consolidated net operating loss deductions in this case. Specifically, in 2018, $13 million, 2020, $14.9 million, and 2021, $1.1 million. We're talking some real tax dollars here. So, what exactly went on? Okay, here's the history. The petitioner, HBM, was incorporated as 2014 pursuant to an F reorganization and elected S corporation status at that time. As part of its reorganization, Mississippi Lime Company, another corporation, became HBM's wholly owned subsidiary, electing qualified subchapter S status, right? Mississippi Lime Company then distributed 100% of Delaval Holdings LLC stock to HBM. Delaval was a loss corporation carrying approximately $78 million in net operating loss carryovers at the time. So now we have the sub of the sub, right? Whose stock was distributed up to HBM Holdings, right? Effective July 1st, 2018, HBM revoked its S election, terminating the qualified subchapter S status for its subsidiaries, right? Concurrently, Delaval, weird name, whatever, filed a check the box election to be disregarded as separate from HBM. Under the regulations, Treasury Reg 301.771-3, this action resulted in a deemed liquidation of Delaval into HBM at the close of June 30, 2018. Just prior to the revocation, HBM succeeded to Delaval's NOL carryovers, which had grown to approximately $108 million by this time. So we have a nice big chunk of NOL sitting here coming from the former subsidiary of a subsidiary. Okay, all of those issues. Now, here's the mechanical heart of the tax dispute. Under Treasury Regulations 1.1502-21, subsection C1I, SRLY losses can only be included in consolidated operating loss deductions to the extent of the consolidated taxable income attributable to the member that holds the losses. HBM is a successor to that loss corporation, was that member, but HBM, on a separate entity basis, generated exactly zero separate taxable income for the taxable years in question. It was the holding parent, even though the consolidated group reported massive incomes. Therefore, the IRS view, the SRLY limitation was zero and the deductions were properly disallowed per the court. Okay. Now, here's the catch. HBM said, wait. When that sub was liquidated into HBM inherited the tax attributes under 381, making them indistinguishable from its own NOLs. But Judge Jenkins, writing for the court, pointed out that while Section 381A transfers attributes, it is subject to limitations of 381B and C. The regulations under 381 explicitly requires separate tracking of distributor and acquirer attributes. The court rejected saying that Dover Corp and related revenue rulings, were relevant, saying they're not in this case. They were cited by the taxpayer because they dealt with business history rather than separate NOL tracking. Different concept. Now, HBM argued that original sub, the sub of the sub, was not a predecessor because at the time of liquidation, the consolidated group did not exist. The tax court started with the plain meaning of Treasury Regulations 1.502-1F1, at least in the court's view. A predecessor is a transfer of assets to a member in a Section 381 transaction. Delaval, which was the sub of the sub, was indeed a transfer order to HBM in a 381 transaction. The court ruled the predecessor status is evaluating the tax year the attributes taken into account, not at the historic transaction date. Furthermore, the court noted that the lonely parent rule exception conspicuously fails to mention predecessors. You're going to find that in the regs, whereas other exceptions in that same regulations explicitly do mention that. So you can't use the lonely parents rule at regulation 1.1502-1 subsection F2I. Again, one of those issues. As another alternative, hey, wait, we got another idea. HBM argued that the founding members should be treated as basically an SRLY subgroup based on economic reality and common control. But Judge Jenkins rejected this. S corporations are ineligible corporations that cannot form an affiliated group under Section 1504b6. Since we had disregarded subs, there was no former affiliated group. The court refused to create an exception based on economic reality. Saying, I mean, what HBM was saying, look, we treated these subsidiaries as if they didn't exist and we had all the assets. That's kind of like what happens with consolidation. So isn't it really kind of the same thing? No, it's not. Right? Now, in corporations seeking to deduct loss, another corporation must have explicit statutory authority. S corporation history is thus a barrier to forming consolidated SRLY subgroups. That was their problem, right? In essence, saying tough luck. You can argue this issue. Generally, taxpayers are always going to have trouble arguing economic reality when they chose the form of the transaction. That's one usually the IRS is only going to be allowed to argue. Now, next up, one more tax court decision. This is the case of Prezioso versus Commissioner. Tax court decision 2026-63. This decision came out July the 28th of 2026. Right. This case, the tax court sustained a 75% civil fraud penalty under 6663 against Walter, right, for tax years 2009 through 2012. Mr. Prezioso, right, whatever, Walter. The commissioner carried the burden of proof per the court of proving fraud by clear and convincing evidence. The IRS, per the court, easily established underlying deficiencies because the taxpayer conceded them, and the IRS also proved compliance with the written supervisory approval requirements of Section 6751B by showing that the group manager, involved approved the penalties in July of 2021. So let's take a look at this case. Right, here's Walter's history with the company. GSP Precisions is an aerospace manufacturing company incorporated in California in 1983. Walter joined in 1982 and acquired 25% stake in 1997. In 2001, the board made him the sole check signatory. He signed all checks. By June of 2022, his father and George Gottardi, who were the other shareholders, retired, leaving Walter with absolute operational control of the company. He turned the declining financials around and became CEO in 2007. So far, so good. Son comes in, son of one of the founders apparently comes in, saves the day, company is operating fine, things are great now. But here's where things go a little differently. A board resolution of 2009 authorized GSP to pay certain leased vehicle insurance and travel expenses for Walter. But, according to the court, Walter went way beyond that. He directed the company to issue over 400 checks for personal expenses during the audit years per the tax court. GSP paid for his credit cards, home renovations, basically a home equity loan, landscaping, pool and tennis court contractors, and even his boat and RV loans. Okay. Crucially, none of these payments were reported on Form W-2 or 1099 miscellaneous, escaping all payroll and federal income tax withhold reporting. So essentially, all of this, the IRS got none of this put in, right? So none of it shows up as his income, and he never put it on the return. Per the court, again, always want to say that. Walter, if you're listening, judge is saying this. This is all based on what the judge says. Now, if the judge got this wrong, I suggest you get an appeal ready to go very quickly, right? If it's clear that he did, that he's ignoring the facts, fine, but you need to get an appeal running here. Now, a central pillar of the fraud finding was Walter's double bookkeeping system. And Walter wants to get this appeal because Walter really doesn't want to pay the 75%. Believe me, you do not want to pay 75% of this number. Because GSP had no on-staff accountant, Walter was responsible for the bookkeeping. Yeah, what could possibly go wrong? In that case, he maintained two distinct chart of accounts. That's probably not a good thing to do if you want to convince a court that you're not really trying to play fast and loose with the books. In the internal chart shown to shareholders, he entered false payee names using actual business vendors like Cohen Precision or Quality Heat Treating to disguise checks written for his personal cards. At the end of each month, before sending the files out to his outside CPA, John Craven, he changed the payee names back to correct payees, exported the report, and then reverted them back to false names in GSP software. The court found this double bookkeeping is classic circumstantial evidence of fraud. He was effectively telling one story to the other equity holders, right? But then gave a different story to the CPA he wanted to do the tax return with. Because, the CPA might notice who the check was really written to. If he's looking at, details, copies of checks, it's not that he's absolutely going to, but he might. So we need to clean this up a little bit, right? Do things like that. Now, the court also found that Walter manipulated GSP's expense coding. GSP's CPA has established specific expense codes such as code 4710 for material purposes and 4718 for equipment repair. Walter coded many of his personal expenses under these codes. Because they were classified as material purchases outside processing equipment repair, they are aggregated on GSP's P&L statements as cost of sales and capitalized as cost of goods sold on GSP's Form 1120. The tax court held that you can't hide behind the tax preparer, the CPA in this case, when they actively withheld or misrepresented information to that same party, which the court found that he did. So, yeah, you basically took steps to assure, that your CPA was not likely to notice the problem, right? You just margins are getting tight. The whole story about, oh, horrible now. The market's horrible. We have to tighten our margins so much because of all the competition, etc. It's a story. It sounds decent at first, right? Now, Walter claims these omissions were an honest mistake and that he was unaware that the payments were taxable income. Yeah, the court's not likely to buy that, which is what happened here. The court didn't buy it. Having found what the court says they found, are they going to accept this statement? Yeah, you got tough here. You're going to have a little tough here. In essence, the court pointed out directly to a credit application he filled out to lease a Ferrari. Remember, the company under these years, to be honest, is not showing any taxable income. And Walter is showing very little in wages. And yet he's leasing a Ferrari. Now, if you've not priced Ferraris recently, let's just say you're not going to lease a Ferrari on a $60,000 salary with no other source of income. Probably not happening. Actually, in this case, $52,950. So on the application, he wrote down his verifiable income was $52,950. That which the IRS would find, that Ferrari would find or the leasing company would find, if they asked to see, if they even like his IRS transcripts, it would only show $52,950. But that he had actual income of $275,000. As you might guess, since that piece of evidence came in, the court's simple question is, what the heck was the other income? What's the actual income? Right? Actual income meant what I didn't put on my tax return. That's the implication the court drew from it. Right. The court found this was a smoking gun. He knew his actual compensatory income was far higher than W-2 salary was reported. The court also cited his willful blindness in signing corporate returns that reported large corporate losses that were caused by some personal expenditures. I mean, he kind of knew he had a pool, he had a Ferrari, right? Whatever. He knew he had these things. He knew the company was paying for them. Why didn't he think they would impact the losses? That's the court's view on this case. Okay. Now, here's the other catch. Joint and several liability of his spouse. Kimberly, who's married to Walter, did not participate in the bookkeeping manipulation or the deceptive scheme. She never signed a return. However, they timely filed joint Form 1040s for the years in issue. Under 6013D3, spouses filing a joint return are each fully responsible for the accuracy of that return and are jointly and severally liable for all taxes and penalties. Consequently, as of this point, Kimberly is fully and jointly liable for these fraud penalties. Yep, remember, there's a downside to a joint return. Yes, you're probably going to pay more tax if you file separate. And yes, you're probably going to pay more to get the returns prepared if you file separate. But if it turns out that your spouse, even without your knowledge, And I could see a spouse just not worrying about it. I mean, you know, when I was married, did I go actually review my spouse's paycheck every week? And did she look at mine every week? No. We just accept, the money went in the bank account. It seemed to make sense. It seemed to be in line with what she should have been able to earn. Should have been in line with what I should have been able to earn. Neither one of us was there actually checking. She certainly never came down to our office, and took detailed looks at the books of the CPA firm to make sure we weren't doing stuff. And she actually was trained enough to have the background. Maybe she wasn't trained as a CPA, and she's not a CPA, but she would have understood if something this blatant was going on. But, she didn't come down, and, I didn't go down to make sure that, somehow, that she was, in her case, you know, not somehow having cooked books. She wasn't an owner of the business. But, you never know. Your spouse could be involved in some sort of illegal activity generating income. But no, I just assumed, as she assumed, as most spouses are going to assume, that their spouse, they've got it. If it's not out of line, yeah, they're getting it from, where they say they're getting it. But when you sign that joint return, turns out your assumption that there's nothing wrong had my spouse's assumption that I wasn't doing the same thing as Walter here, or at least what the court says Walter did, or she wasn't doing something else, getting illegal money and not reporting his income. Either one has been wrong in that assumption, and the other one had been fraudulently, signing off on the returns, reporting the income. Each of us, either of us could have been liable for the fraud. Just the way it works. Yeah. Okay, so some people now are never going to get married ever for any reason, but that's a whole nother issue. Okay. So this is the coverage for this week. Right, we're going to go over it. Right. To summarize the key lessons, for variable annuities, private letter ruling 2026-3002 confirms the term certain options are safe under constructive receipt if they carry robust restrictions on assignments, premiums, and annuitants. They meet that requirement. At least that's the IRS's current thinking. For employee retention tax credit litigations in the Court of Federal Claims, it's going to be really helpful to have a discrete, more than nominal segment of the business cease to operate. That's the level that's the level now this court looked at. So we're kind of on a continuum, and this is on one end of it, and at least one of the Mississippi cases in district courts on the other end of it. And yeah, it's going to be messy if you're now, luckily I'm not an attorney, so I'm not going to take anything to trial here. But yeah, if you're going to trial, you're like, okay, which end of the spectrum, let's say, would the U.S. District Court in Arizona fall on? Yeah, we might, we may find that out. For corporate reorganizations, you got to remember HPM Holdings. S corporation history is a barrier to consolidated SRLY subgroupings, and check the box elections do not clear historical loss trackings. A lot of ifs there. And finally, the last decision we discussed highlights the dual chart booking systems and miscoding personal expenses are likely going to be read by the court as evidence of intentional fraud in the tax returns that come from those things. And that can lead to severe civil fraud penalties. And if you're married to that person and signing the returns, yeah, you might be clipped too. Technically, she should be able to try certain options to get out, due to innocent spouse, but she's got to raise that claim. That's going to be separate. And Walter may fight that claim. Yeah, it could be there because Walter has a right to challenge that. So thank you for basically listening here today. Remember, as always, you can email any queries to ed.zollars@currentfederaltaxdevelopments.com. You can check online on Current Federal Tax Development's website to see what we've got coming up during the week. And I also do pay attention to the Connect sites run by the Arizona, New Jersey, Idaho, Minnesota, Illinois, and Washington Societies of CPAs. So if you have questions there and I see them, I may answer back on that. Otherwise, we will hopefully see you back here next week for more current federal tax developments.